gas prices, inflation, recession, reports of home sales dropping, and a looming market crash?
The best way to look at what's ahead is to analyze the past data and compare that to where the housing market is right now. I'm Paul Jonas.
And I'm Amy Jonas with the Jonas Homes Group. We are powered by EXP Realty, and we are living, loving Las Vegas. This chart shows housing price appreciation all the way back to World War II. There is only one period where housing lost significant value, and that was between 2006 and 2012. The reason for that drop was loose lending limits. No income, no asset loans, and cash out refinances, people using that money to finance a lifestyle.
Daniel Hale from Realtor.com said, "We have learned from history that prices can fall. The more important question is if that's going to happen now. And that's hard to say. In other words, a market crash would be difficult to materialize based on the data we have today."
The Urban Institute shows lending product risk going all the way back to 1999. The red area shows risky loan products leading up to the crash. Lenders did away with risky loan products, eliminating risk to lenders and significantly reducing borrowers' risk. This graphic tells the story of the difference between 2008 and today.
This chart shows foreclosure activity since 2005. The red bars are years where foreclosures were over 1 million homes, and the blue bars are years under 1 million. Foreclosures are almost non-existent right now. This chart from the Federal Reserve shows volumes of loans for credit scores under 620. The red bars show risky loans leading up to 2008 versus the blue bars after 2008, where lenders tightened standards.
The other concern we hear is people are not going to be able to support the debt as prices go up. This is the household debt service ratio for mortgages as a percentage of disposable income. In 2007, we were at 7.2%, and the latest numbers show that we are currently at 3.8%, the lowest we've been since 1980. Will that go up? Yes, and it is a leading indicator that experts watch for signs of an unstable market. We are not there yet.
Another indicator to watch is the cash out refinances. The years leading up to 2008, people were taking cash and increasing their yearly mortgage payment by thousands. The last 2 years, only increasing their mortgage by $66 and $34 respectively. People have been smart by refinancing their homes for the lower interest rates, but not harvesting the equity in them.
So what's ahead for the 2022 housing market? The most recent forecast from the 7 forecasters that we follow are predicting a 9% average increase for the year. Experts have revised their forecast up since the beginning of the year. This graphic shows what the forecasters are predicting through 2026. More normal yearly appreciation rate. No depreciation predicted.
How high will mortgage rates go in 2022? Well, Bill McBride from Calculated Risk said this. Based on the estimate for the peak Fed funds rate, the 30-year mortgage will likely peak between 5 and 5.7%. There is some variability in the relationship, so we might see rates go as high as the low 6s. This all depends on inflation and the Fed funds rate, but I don't expect rates to move much higher than the current rate, although 6% is possible.
This chart shows the change in a 30-year fixed rate principal and interest only mortgage payment at $300,000. In just a little over a year, the payment has jumped almost $500 a month. This is a big jump and one of the reasons we are hearing about a looming market crash.
So what about affordability? Well, Bloomberg stated, new data from the Harris poll shows 84% of Americans plan to cut back spending as a result of price bias. And more than 70% of respondents said they were feeling the effects of inflation the most in gas prices and groceries. Now, we can all relate to that.
Let's take a historical look at the Housing Affordability Index put out by NAR. This index considers house prices, interest rates, and wages. All three are going up. The way to read this is the higher the bar, the more affordable houses are. The orange bars are the years when all those foreclosures hit the market. If you look at today's affordability index, houses are still more affordable than they were before 2008 and going back to 1990. If you think housing is not affordable, you have to ask, as compared to when. A little historical perspective goes a long way.
The National Association of Realtors wrote this: the average consumer is spending an additional $429 monthly for items other than shelter. Meanwhile, average weekly wages rose just $212 per month, so the consumer is short by $217 per month. This means that the average consumer will be looking for a home that is $41,793 cheaper. Inflation will force the consumer to make a decision. Do I get out and say this market is not for me? Or do I look to long-term wealth building and buy a home before rates and prices go even higher? Either way, you should make a decision that is best for you and your family.
If you have questions, let's connect. Thank you for watching. I am Amy Jonas.
And I'm Paul Jonas with the Jonas Homes Group. We are powered by EXP Realty.
And we are living, loving Las Vegas.